Welcome, everyone. I'm Sarah Wheeler, Editor-in-Chief at HousingWire, and I'll be moderating this Lunch and Learn about the latest FHFA and HUD policy changes. We have seen a lot of federal activity over the last year, but especially over the last few months. And we've gathered trade group leaders and other experts today to give you insight on how these changes impact origination. So we have leaders of all different trade groups. We're really excited. We hope to have time for audience questions, so feel free to send those in the chat. I'm excited to welcome our guests today who are taking on this important topic. We have Ben Cole, the Director of Trade Desk Operations at MCT, Sasha Hewlett, the Director of Secondary and Capital Markets and Residential Policy at the Mortgage Bankers Association, Chris Cully, a partner at Mayer Brown, Elizabeth LaBerge, Senior Director of Advocacy and Counsel at Credit Union National Association, Brendan McKay, President of Broker Advocacy at the Association of Independent Mortgage Experts, and Scott Olson, the Executive Director at the Community Home Lenders Association. Those are their official titles. You know, we usually say MBA, CUNA, AIM, and CHLA. So we're happy to have all of them here, and we're ready to jump into our discussion. So, you know, all of you, we've seen a lot of policy changes in the last few months from both HUD and FHFA that directly impact lenders. One specific topic we'd like to take on today is the preferred stock purchase agreements, which the FHFA under Calabria amended earlier in the year, only to have the current FHFA acting director, Sandra Thompson, roll back. Those changes affected investment properties and higher risk loans and caps on both of those kinds of loans that Freddie and Fannie could buy. So Chris, can you walk us through the timeline of some of these changes?
Sure. Thanks, Sarah. And hello, everyone. As you mentioned, the timeline is, if we wanted to take it all the way back, these preferred stock purchase agreements were undertaken as a result of the financial crisis in 2008, when the Treasury Department committed to invest in each GSE, Fannie Mae and Freddie Mac, in order to keep them solvent and to keep them in a positive net worth. And in return for that backstop, the Treasury Department obtained these senior preferred shares of stock, in addition to lots of other complicated arrangements. But these PSPAs have been amended over time to kind of address the fact that the GSEs were continuing to sort of recapitalize themselves, but the Treasury Department and FHFA have kept it in place to ensure that the taxpayers are protected, because as you know, the taxpayers are what represents the Treasury Department and the Treasury's commitment. So, but bringing it up to the present, in January of this year, former Treasury Secretary Mnuchin and former FHFA Director Calabria executed these letter agreements that affected the PSPAs. And there are a lot of details in those agreements and the amendments, but for purposes of today's discussion, the key elements were that those amendments were seeking to kind of constrain the acquisition by Fannie Mae and Freddie Mac of certain what those officials considered to be higher risk mortgages, to safeguard Treasury's backstop of the GSEs and to allow them to kind of recapitalize themselves. Those limits related to loans with high LTVs, high DTIs, and or low FICO scores. It also related to qualified mortgages. I'm sure a lot of you are aware that at that point, the GSEs announced that in light of the CFPB's QM rule, the GSEs would only purchase those new APR related QMs, and that essentially did away with what we've been calling the GSE patch. And importantly, the limits in these agreements related to loans secured by second homes or investment properties. And that was really key because it was at a time when those loans were really popular, and it was rolled out in sort of a very confusing way. These portfolio limits over this rolling 52-week period. It was really confusing for a lot of lenders as to how it would affect their sales to the GSEs on an individual basis. So it was a pretty confusing period of time. So those the GSEs issued some guidelines as to how they would implement those limits. On June 23rd of this year, the Supreme Court held that the president has the authority to remove the FHFA director. On June 23rd, the White House appointed Sandra Thompson as the acting director of the FHFA. And then several weeks later, the FHFA and the new Treasury Department suspended certain portions of those limits that the prior administration had effectuated. So those suspended provisions include the limits on the GSE's purchases of those loans with the higher risk characteristics, and the limits on loans secured by second homes and investment properties. So those limitations are being suspended. The suspension with regard to the QM was not lifted, so that's still in place. So I believe lenders have generally favored the suspension of these limits by the new administration, but certainly other players in the marketplace may have been eager to sort of find or create a separate market for those loans. So there's always two sides to every story. I look forward to hearing what the other panelists think about that.
Thank you for that recap. This is, this is a complicated matter, and so distilling it down for us like that, I really appreciate. And Sasha, I wanted to go to you because I know that MBA worked to get some of these changes rolled back, and I'd love to get your perspective on how some of these changes have affected originators.
Yeah, definitely the changes or the suspensions of the limits were a very welcome announcement after months and months of advocacy, starting from months and months and months ago. I mean, meetings, letters, a lot of things finally came to fruition once these were suspended. So I think the first thing that we're noticing from our members, or we're hearing from our members, and that we expected to come from the suspension of these limits, is a lot less disruption. As Chris mentioned, the implementation of these caps was very problematic. They were, backward looking. They really impacted lenders' pipelines. You've got loans in the pipeline, months ahead, and then all of a sudden you're not able to deliver these that you thought you would. So it really did cause quite a bit of issues. So I think that's really the main thing, a lot less disruption. I think lenders are going to be able to kind of return to a little bit of normalcy as far as how their operations are going to work. And I think that's, the GSEs and FHFA are expecting to be a stabilizing force in the market. And I think we're kind of seeing a return to that with the suspension of these. That being said, we do think FHFA is still going to use their authority to kind of monitor the risk level of the GSEs and what loans they do acquire, but I think they'll do it in a much better way, whether that be through pricing, underwriting system, whatever other method they choose. I think they recognize that there is a way we can manage this risk without having to, do it on a per lender basis that doesn't really make much sense, or a backward looking, basis that is really, really hard to implement and impacts pipelines and impacts the borrower at the end of the day. So I think that's what we're going to see, a lot less disruption, and then a big reevaluation from FHFA and how they want to monitor this. We were really happy that they decided to kind of suspend and reevaluate. And so this will be suspended for, I believe, at least a year before we see anything else on that front.
Well, thanks for that. Scott, last week you wrote an opinion piece for Housing Wire that lauded some of those changes as beneficial for smaller lenders. So, I'd love to get your take here.
Well, thanks, Sarah, and thanks again for the opportunity to participate here on behalf of CHLA's members. We're small and mid-sized independent mortgage banks. As you've been watching these days, things can whipsaw here in Washington pretty quickly. So that op-ed pointed out that several years ago, smaller lenders were actually playing defense, fighting Wall Street banks' efforts to gain GSE charters and use the common securitization platform for their benefit. Today, things look much better. One thing that is maybe overlooked is back in January, we had a big victory. One of our top priorities was making G-fee parity permanent in the PSPAs. Regarding the PSPA restrictions, CHLA called back in March for these to be suspended because they were terribly disruptive for our members. We had some of our members, or because they were retroactive, were cut back to 3% and even 0% on these investor and second home loans. So we believe that Acting Director Thompson's work with Treasury to suspend the restrictions was huge. Honestly, You can't pursue an agenda of equitable housing and racial equity with these artificial caps on GSE higher risk loans and with caps on investor loans, which are commonly used for rental housing. And we're also heartened that the artificial PSPA cap on small lender access to the cash window is suspended. Obviously, there's self-interest here. It affects our members, but obviously, we believe that more access for smaller lenders means more competition, a broader market. That means better rates and better service, and we think all those are great for consumers.
Yeah, Elizabeth and Brendan, I'd like to know what your thoughts are on this as well. One of the reasons we wanted everyone on here is, you all sort of represent different constituencies, and so I'd love to know, what this means for the members you represent.
Yeah, sure. So I definitely agree with Chris that it was confusing when it was rolled out. Not only confusing to explain to borrowers, like why there's caps on certain amounts of loans getting delivered to Fannie and Freddie is not really a conversation most originators are having with their customers, but also for us at AIM to explain it to our brokers was very difficult, because that is a level that most originators are not getting in the weeds and secondary on that account. And I agree with a lot of with our panelists that it was definitely problematic for the market at large. I will say, though, specifically for brokers, kind of what Chris was getting at, it was a market advantage for us. During the time when you saw the caps specifically on second homes and investment properties, you saw wholesale lenders moving their pricing in and out of the market, right? Like, okay, I'm over the cap. My pricing's way out because I can't take on any more of these loans. Oh, we've got room. Like, let's get our pricing really aggressive. And when you're an independent mortgage broker, that is a market advantage, right? I can bob and weave between those lenders. Okay, I have an investment property. I'm going to originate with this lender this day and another one the other day. And at the end of the day, the brokers, consumers are going to get the best pricing in a model like that. Now, I'm not going to sit here and say that FHFA should, regulate based on strictly what's best for brokers. It obviously creates a lot of problems at a higher level other than that, but it was definitely a nice little niche for us while it lasted.
And I'll jump in, and thanks for having me. The hard caps definitely created real difficulty for credit unions trying to serve their members' needs. Credit unions and federally chartered credit unions in particular, which are majority of the credit union movement, are statutorily limited in their lending. The Federal Credit Union Act limits the maturity on loans for non-owner occupied properties to 15 years. And that's a period that's not really competitive or in line with member needs. So because of those statutory limitations, sale of non-owner occupied loans to the GSEs are really a primary source of liquidity for investment property and second home loans for credit unions and their members. So if credit unions have to keep these loans on their books, they're simply not able to be competitive and meet their members' needs. So implementation of the caps are felt very, very quickly in credit union land. That tightened up liquidity in the market for investment properties, and some credit unions were having to turn to correspondent lenders to offer those products to their members. And of course, those costs are then passed on to consumers, leading to an increase in the cost of credit. And in areas that are particularly unbanked or underbanked, credit unions definitely reported a lack of ability to lead lending to an increase in the rental property prices in that area, which are then passed on to renters. And last year was a very hard time to be a renter in this country. So it had that immediate strangulation effect. And credit unions definitely reported, same as Chris said, same as Sasha said, that this was disruptive. Credit unions that exceeded the caps were very confused, and they didn't have information about how and when they could proceed again with the product. So we were greatly relieved when Director Thompson indicated she'd have conversations with Treasury about it, and absolutely thrilled when they suspended the provisions. And we really, really, really hope that that suspension remains permanent.
Yeah, thanks for
Sarah,
that.
I don't think that I don't think you can understate the importance of understate the importance of suspending the cash window cap. We have a couple hundred clients that sell to the two agencies, and you've got your very large clients that already do MBS, but we did have, and you've got your very small clients that would never have hit that 1.5 billion cap. But we have a significant population of our clients that you're kind of on that fence, and we were, working with them and re-engineering their executions to MBS going away from cash window, but they're not of the size to achieve the same pay-ups on those low bal spec pools that they can achieve by delivering to the cash window, which just means that your borrower is going to wind up getting worse pricing because they're not going to be able to pass that on to their LOs in terms of front-end pricing. So, and I know we're going to talk about equitable housing and fair lending, but generally speaking, those 85, 110, 125, 150 low bals, that's also going to be your CRA type clients or borrowers. So, I'd say just net, I think it's better certainly better for the lenders, but I think at the end of the day, it's definitely better for the borrowers that would enjoy those specs.
I really think that's such an important thing to talk about today, is that, sometimes we just want to focus on the business of it, but the business of it is getting people into homes, into sustainable home ownership, right? So I do think that, talking about the effects on the borrowers, of course, that has an effect on the lenders, but you do wonder, like, those kind of knock-on effects, unintended consequences maybe of some of these decisions that aren't always obvious maybe to some of the people making them. Well, let's move on to, the PSPA changes aren't the only ones.
Sarah,
Yeah, sure.
I'll just make one quick broad point. I think the fact that the PSPA changes were sort of done somewhat in secret, without debate, illustrate how important it is for like what you're doing with these webinars and more debate in Congress about what the role of the GSEs and what their market. I mean, there needs to be, if we're not going to have a bill in Congress that's going to reform the GSEs, we need to have much more public debate about these kind of issues so we aren't blindsided. That's just kind of a broader point. So.
No, I think it's an important point, because what you guys all saw on a very real level was just how this affected people in a way that, especially when changes are made so fast and there's not given a lot of time, or the timeline is shortened, then that has real consequences to your business. But what that means is it has real consequences to borrowers at a time when the federal administration really seems to be focused on really wanting to make sure that people have opportunities. So I think that's exactly why we wanted to do this. So appreciate that. Those changes aren't the only ones that FHFA made. In July, the agency killed the adverse market fee. I think everyone on this call would be excited about that. And if I'm wrong, please raise your hand and jump in. Also, they announced it at MBA Annual just a few weeks ago from the stage that they were making desktop appraisals permanent. So I'd love to hear from all of you about the ways those actions affect lenders and whether you expect more to happen on the valuation front. So Elizabeth, let's go to you first and weigh in on that.
Absolutely. We were thrilled about the elimination of the adverse market fee. The truth is credit union mortgages are exceedingly safe, and they serve populations that sometimes other financial institutions don't or can't. I think 2020 HMDA data, the average credit union mortgage sold to a GSE was $203,911, which is 32% smaller than the average non-bank mortgage and 38% smaller than the average bank mortgage. And while non-credit union lenders saw a larger increase in delinquencies overall comparing 2019 and 2020, credit unions didn't. In 2019, the delinquency rate at banks hovered around 1.5%, jumped above 2% in the second and third quarters of 2020 after the onset of the pandemic. The credit union delinquency rate has still been hovering between 0.45 and 0.55%. So while the non-credit union mortgage portfolios are still recovering, the delinquency rate for credit unions is already below the start of the pre-pandemic levels. Delinquencies in 2021 remain the lowest of the past 5 years, all of which is to say that additional fees like this that are intended to offset risk, like the adverse market fee, really makes little sense in the context of credit union mortgage lending. And the risk associated with credit union mortgages is low, relatively speaking. And increasing the cost and the impact on loan affordability is so much more significant when you're looking at a principal balance that is lower. It really can have an impact on credit unions' ability to lend to those that are most in need of that financial access. So elimination of the adverse market fee was a really big deal for the credit unions. We were very excited. And switching to the appraisals, the ability to continue with desktop appraisal is fantastic too. What's most important to my members is flexibility. different property types, different loans need different appraisal solutions. Sometimes you do need that in-person appraisal, but sometimes a desktop appraisal or an AVM can get the job done well and equitably and quickly. And so because there's no one size fits all solution, it's really in borrower's best interest that everybody have appropriate flexibility to determine how an appraisal should be done based on what the property is, how unique it is, where it's located, the presence of comps, and those kinds of considerations. I will say, and I know we're going to talk about this a little bit later as well, but my members are very upset about the increase in racially biased appraisals as indicated by the increase in HUD complaints. Obviously, credit unions, like every other mortgage lender, is dependent on the quality and the objectivity and the reliability of appraisals, not only to manage their own risk on their books, but for credit unions to serve their mission in their communities. And so we're paying attention to the PAVE task force, to what Chairman Harper, the NCOA, is doing in the FFIEC's appraisal subcommittee to increase the number and the diversity and the accountability of appraisers in the US. And that combined with this increased flexibility out of the FHFA, we're really hopeful that that'll help improve the racial homeownership gap and resolve these bottlenecking issues that we see coming towards closing.
Appreciate those comments. Sasha, I was going to go to you next.
Yeah, I just want to, so obviously, again, I can't reiterate enough that eliminating the adverse market refinance fee was huge. And just to go back to Scott's point a little bit earlier, I think that was kind of one of the first policy changes that was just implemented so quickly that, it just has so much of a disruptive impact on the market when you have something that is kind of immediate and the market does not have time to adjust and absorb and get ready for this fee. We were able to get that pushed back, which was very good. But I still think it was adding cost to consumers, and I'm really happy FHFA, took a step back and said, things have changed. The pandemic is no longer in the state it was before. So this is something that we can reevaluate and eliminate. So we were very, very, happy about that as well. And switching to appraisals, again, the desktop appraisals is huge, I think. We hear from our members all the time that appraisals are a huge issue right now. There's a shortage of appraisers. The turn times are super long. It is a huge issue right now. So to have something that could, provide some sort of assistance now, having to, get more people into the appraisal industry and kind of solve those bigger issues is going to take time. But I think desktop appraisals is something that can help now. And it's something that was tested, during the pandemic when we had to use desktop appraisals, we saw the benefits of them. So I think seeing the benefits of how they helped the industry over the pandemic only makes sense to implement them now and use it as a valuable tool to help our industry. So.
Love that. Anyone else from the panel want to weigh in on the desktop appraisals specifically?
Yeah, I think that you're going on 10 years of using collateral underwriter through both agencies. So I mean, there's a mountain of data on most properties in any kind of a urban or suburban area. So the more waivers that could be granted through the various their respective AUSs, and then certainly using desktop appraisals. But anything that'll speed the entire process of a loan from moment of lock to when it's funded, from a hedge perspective, is going to limit the amount of time that loan is in the hedge, which reduce the hedge costs for our clients. Which going back to the previous point, if their costs are lower, they can pass those costs on to the borrowers at the end of the day. So I just think the amount of information, is certainly with the last couple of refi booms over the last 10 years. If you think about collateral underwriter, it's not just when that house is the subject, it's how many times it's used as a comp. So I can't imagine how much information they may have on one specific property. I mean, it's probably shown up in hundreds of appraisals over and over again. So.
Yeah, and on our side, we're like everyone else, we're in favor of them getting rolled out as far as desktop appraisals. We do have concerns that we do believe it's a Band-Aid solution. In long term, it could cause problems. It's going to lead to an inferior product on the appraisal, with the appraiser not being able to make statements as far as the condition of the home. And there's also, I think some of the details are still getting rolled out, but we've heard that possibly a floor plan is going to be required for it to be eligible for a desktop appraisal, which really means you're talking about purchases. And appraisers are very wary about going off listing photos to see inside the home. So We're happy it's happening. I think the long-term solution is technology. One of our partners, and in particular, is rolling out scanning technology. Class appraisals are testing it in 5 states right now. That would give a 3D scan, including square footage of every single room in the house. And I think that is really where, we're looking for FHFA to basically give their blessing on letting this type of technology be used. Not only would it speed up the appraisal process drastically, because you could have someone other than the appraiser, like somebody in between Uber rides, dropping it off at the house and stuff like that, and improving efficiency. But it fixes, or it starts solving some of the other problems that we're going to talk about later as well. And then the other thing that we'd love to see them roll out that was happening during the pandemic was when you have situations where you're talking about final inspections, not necessarily needing the appraiser, especially a bunch of appraisals who are have more than they can handle already, going back out there, taking a picture, saying it's good. We really don't see any reason that it can't go back to whether it's the realtor or the seller, whoever's taking a picture, or a licensed contractor saying that, yep, we're good, off it goes, and saving the consumer a little bit of money along the way.
Scott, did you want to weigh in on this one?
I'll wait for the next question.
Okay, good. Appraisals are just it's a thorny issue. You guys have brought up a lot of things. The fact that we don't have enough of them, the fact that there's been, a lot of allegations of appraisal bias, and then, how is that handled better by an algorithm or by automated, models? So, one of the things we looked to last year when FHFA put out a request for input on appraisal modernization, that we thought, wow, this is going to be big. So obviously this desktop, making that permanent was one thing. Chris, are we expecting more to come out of that? They got a huge reaction from that RFI.
Yeah, they did. And so the FHFA has been studying the appraisal process for a long time. They're aware of all these pressure points, the lack of availability of appraisers, the length of time. They understand that this is a significant hurdle to getting lenders able to provide home ownership credit. But at the same time, the GSEs are worried about the accuracy of the valuations. It's critical for the safety and soundness of the GSEs and for the entire, housing finance system. So striking the right balance has to be really carefully considered. As Ben mentioned, they have a ton of data, but as we've seen this week, sometimes algorithmic modeling of home values over time and across markets, it's not easy. It's certainly not easy. So I think that the FHFA may make some incremental flexibilities available. But as others have mentioned too, I think that the FHFA is going to really have a keen focus on their participation in the Interagency Appraisal Task Force, on the impact of the appraisal system on equity in home valuations. Freddie Mac had a study, and I'm sure I don't need to tell all your viewers about the impact of that. So I expect FHFA may address these incremental flexibilities, but at the same time, they're going to focus on what the root causes are underlying, what Freddie Mac found, looking at that systemic issues, all the while trying to ensure that the valuations are accurate. So it's a tough needle to thread, which is why I think it may take some time, and big changes are probably more likely to be incremental. That's my prediction.
I appreciate that prediction. I've talked to several people this week who feel like that interagency task force is going to be the key, like looking to that as opposed to any more solitary action coming from FHFA is going to be more like from that appraisal task force. So that'll be interesting. We're definitely watching that. Before we move on to HUD policy changes, we need to talk about the equitable housing goals that FHFA has for Fannie and Freddie. What are lenders are doing to be ready for those changes? Do we even know what those changes are? And what does that mean for the people that all of you guys represent or work with? And I don't have a lead on that. So anyone who wants to start off.
I can jump in on that. For us at MCT, we're just advising our clients to remain nimble. There's certainly, we had a couple new programs rolled out this summer with Refi Now and Refi Possible. When we get into next year, we'll have to see what other programs roll out. One of the other things we're also advising them, though, is just to make sure they have a full understanding of their loan purchase agreements with their various investors or with the GSEs. It's possible that any new programs may continue to step further out on the credit spectrum. Obviously, with Refi Now and Possible, you're talking about a 65% debt ratio. But we don't know if any new programs may step further out on the credit spectrum. Listen, we just had 531,000 jobs, and stock market's going great and everything. But if the economy does suffer a hiccup, in the next few years, unfortunately, it's going to be those borrowers that were put on those riskier products from a credit spectrum. They're going to be the ones that are disproportionately impacted by that economic hiccup. So, what is one person's equitable lending in 2022 is another person's predatory lending in 2024. So we're just advising our clients to make sure they understand what's in their loan purchase agreements, and not to take a stroll down amnesia lane to 2005, 2006, but a lot of loans that we thought that we actually sold to somebody, we realized we had actually just let them borrow for about 3 years because they put them back on our doorstep 3 years later. So we didn't really sell them anything. We just leased it to them for 3 years.
So I'll jump in next. Sarah, the recent changes like ending the adverse market fee, the Refi Now and Refi Possible they just mentioned, and desktop appraisals, we think they're good, but we think more can be done. I mean, in particular, CHLA is pushing to have FHFA look at LLPAs, make sure they're not an obstacle to underserved borrowers, and look at their credit box, make sure it hasn't been tightened over the last 6 months, because we've seen a little of that, we think. But one of our major initiatives is to have FHFA extend the G-fee parity requirement to also apply to private mortgage insurers. This would prevent them from offering the volume discounts to large lenders that we're seeing. And we think this is relevant to equitable housing because those volume discounts hurt the underserved borrowers that our smaller IMB members are serving. And just point out there are other equitable housing opportunities outside of the GSEs. Congress is on the verge of funding $10 billion for down payment assistance for first-time home buyers, which could be helpful. And we particularly think the CFPB should adopt recommendations from the state HFA organization, NCSHA, to make the LO comp rules more flexible for state HFA first-time homebuyer programs. And of course, we're going to talk about FHA in a minute. So there's a lot of things across the board that can be done on equitable housing.
Yeah, and our stance, we agree with Ben that there's part of this solution is expansion of products or possibly guaranteeing the securitization of more manual underwriting, because we're talking about in underserved communities, we might have non-traditional credit because a lot of these communities were left out of the decision-making process when we designed the credit scoring model in the first place. And it's one thing for banks to be able to go invest in these communities and keep these loans on their books or different things like that. But if you're talking about, correspondent lenders, we can talk about very large correspondent lenders that at the end are looking to securitize and sell these products. It's a different thing, and the GSEs are going to need to step up and either create new products, and maybe the Fed pledges to, purchase a certain amount of these securities or something like that, and make sure that there's a marketplace for it at the end of the day. Whether it and more manually underwritten stuff or whatever the solution might be, that those are the terms we think they need to be thinking on. And that's kind of in the immediate bigger picture. We think longer term, we need, and us as an industry has the responsibility to do this. We need to put a focus on bringing education to these communities on based on their experiences and not just the same talking points that we've been putting out there over and over. So simple things like mortgage applications and disclosures in foreign languages. That should just be standardized at this point. There needs to be building up leaders and originators and broker owners or branch managers in these communities. And AIM's put a big focus on this. We've raised and distributed millions of dollars in grants. In the last year, we've created 70 new broker owners in these communities focused on minority-owned brokerages, veterans, and women. And we think just like, I don't know, that the line is like teaching not to preach, but create real generational impact is where we should be the focus long term. Like Band-Aid stuff, yes, like we have a problem right in front of our face. Let's do what we can to fix it. But what are we doing long term to really fix the root problems is where we think the industry's focus should be at.
And I'll jump in
Just
building
to
off of what.
piggyback off what,
No, go ahead, Sasha.
sorry, just really quick, I just wanted to piggyback off what Brendan said and just tie in the Equitable Housing Finance Plans that FHFA recently rolled out as well. I feel like we can kind of see the perspective that the kind of new leadership at FHFA has as far as equitable housing and closing the minority homeownership gap and the wealth gap, et cetera. So just wanted to tie in that we have those goals as well. I do like that that is a kind of longer term 3-year plan with kind of looking at things every year or so. We submitted comments recently and we even suggested, you know, maybe making it even more durable with the rulemaking or something so that this is not just a, you know, one-time 3-year thing. It's something that is in place long after, you know, whatever happens and however long it takes for the GSEs to exit conservatorship or what happens in the future. That's something that's going to be there, and that's not work that's just going to be kind of done for a short period of time, because in the grand scheme of things, I think 3 years is rather short, and it's a problem that's going to take much longer to fix than that. But that it goes on for much longer. So I do like the direction and the focus that everything is getting right now. And yeah, I look forward to seeing what happens with that next.
And I'll piggyback off of Sasha's comment about focus. We've already seen this renewed focus on mission at the housing regulators, and it's prompting them to ask questions about what they can do better to improve access to for community-focused and mission-driven lenders like credit unions. So we're having conversations with the FHFA and the GSEs about like improving secondary market access for smaller institutions, how to better serve low-income consumers, especially in high-cost areas. And on our end at CUNA, we're gathering information about what the burdens are for credit unions to participate in FHA lending, to participate in Ginnie Mae issuing, and how to make that more frictionless. So we're excited about program improvements that have been pushed out and looking for more to come. In particular, we were excited also to see Fannie Mae start accepting rental history as a metric of credit worthiness. Credit unions have been considering that kind of alternative credit information for a long time, and we think that experience might be very useful to the FHFA and the GSEs as they look to expand credit access in a way that is risk appropriate. So we also hope to see more discussions on that.
Really appreciate those. We're getting some great questions in the chat, so please feel free to put those in. And one I'd like to that's on this very issue is, are any panelists concerned that the less well-off borrowers are getting an easier path to home ownership at what many fear might be another housing market top? And I do think this is just the larger question here is always, as we look to expand home ownership, obviously the goal is sustainable home ownership. There's no appetite from anyone, I can imagine, that wants to get people into homes who then can't afford to keep those homes. So, you know, is there any worry when we talk about the equitable housing goals from anyone here that's not being addressed, or that we need to address it in a different way?
I think, Sarah, you hit on it.
Go ahead.
Sorry, Scott, real quick. I think you just said it perfectly. Sustainability is really the key here. I don't think anybody wants blanket home ownership for anybody and everybody, especially if you cannot and should not be a homeowner. So I think sustainability is really the key. MBA recently launched our minority homeownership initiative, and at the core of that, while we are looking to close the wealth gap and the homeownership gap, sustainability is always a part of that, because of course we do not want a repeat of 2008. So I think as long as you recognize that while we're trying to fix these issues and find solutions to these issues, sustainability is something that is a part of it at all times. I think you'll find that it's that's not really an issue.
Yeah, I think that we should be concerned. I mean, you want things to be sustainable, but I think there's two things that are fundamentally different from 12 years ago. And I was there, I worked on the committee, I had to field these calls from people that were being ignored by servicers. We learned a lot during the 2008 crisis. We now have very strong loss mitigation programs like partial claim. Those worked very effectively last year during COVID, which was a horrendous downturn among a lot of borrowers. And so I think that's different. We have QM. We're not that wild about the changes that were made to QM, but we do have, I think, much stronger standards that were in place 12 years ago. And we have a focus on servicer performance. And I would argue that the servicers are doing a much better job than they did 13 years ago. So those are always all important if and when that next sort of downturn comes.
And like, I can't agree more with Sasha. I think it's possible to like rethink our current risk models and like the rules that we have to consider prospective borrowers that don't fit our current models without just like necessarily opening the gates to people that are purchasing homes they can't afford. Those are two very different things. And we have a lot of the same rules and guidelines at a baseline debt to income ratio and certain credit score and things like that we've had for a long time. And we can see it's sustainable, but we also have access to so much more data. Every year that goes by, we have more and more and more, and it's going by leaps and bounds. And I think creatively and responsibly looking at that data and seeing if there's potentially people that are being left out because they don't fit our current model, I don't think that's irresponsible in the least. I think it's incredibly irresponsible. And it's just like, in addition to like creating more homeowners, just a decent thing to do and looking for ways to improve the system so that as many people can participate in as possible.
And I'll jump in and echo both Sasha and Brendan that I think a lot of the efforts that we're talking about are intended to address long-standing structural barriers that really have nothing to do with creditworthiness or real risk. So making sure you're on the right side of that line is important. And I would also just reiterate what Scott said. I think he's right on point.
Great, I really appreciate that. We actually featured an article recently from our lead analyst, Logan Motorshami, that says why this is not 2008 all over again. And I think that's a great point, Elizabeth, that some of the things we're trying to do to expand homeownership, or the federal government's trying to do to expand home ownership, is not so much focused on credit as really reaching people who are just been shut out of the process for other reasons. So I think that's really interesting. We did have somebody come in on the chat and say, she disagrees servicers are worse now than ever because of COVID. The stronger standards mentioned are clearly being ignored. So that's interesting. That's an interesting perspective. I don't know that I've heard that very much from people who even the regulators seem to be happy with some of the things going on. So if anyone wants to answer that, great. Otherwise, we'll go on to our next question.
I would jump in, and I imagine that there are some anecdotal stories, but I do know that the CFPB is on task with regard to this. I'm sure we all have seen the news lately. The CFPB has got their eye on these servicers, so to the extent they're not, propping up their loss mitigation programs and dotting all their I's and crossing their T's. I believe that they might be getting visited by a regulator soon. So I think, the CFPB expects, and they've made it very public, they expect servicers to be on top of their game. And I doubt that there's going to be much room for error. So
I would think that most people are on notice at this point, most servicers and lenders. We had another interesting comment that said, talking about how we can talk about addressing affordable housing or expanding home ownership from the financing side, but there are some of those real systemic issues, NIMBYism, tariffs, all sorts of things. We go into zoning, all sorts of issues that so industry can do what it can do, but there's larger policy issues that also have to be taken in, which I appreciate. Chris, I'm going to go back to you. Let's talk about HUD now. We've talked mostly about FHFA, but HUD has been incredibly active this year and has really been, we joked about at the beginning of the year, for the last couple of years, the reporters on our staff who had the HUD beat, it's like, well, what's up this week? What's up this month? And this time, they cannot keep up. I mean, it's unbelievable what HUD is doing, what they've been empowered to do by the Biden administration. Fair housing is a huge priority. And of course, they issued a joint memo of understanding on the issue. Chris, can you talk about the significance of the coordination that we're seeing among agencies?
Yeah, I have noticed that too. It goes without saying that both HUD and the FHFA and increasingly even the banking and other regulators are Biden administration appointees. As between HUD and FHFA, I mean, those two agencies were historically coordinated. So prior to the crisis, before the FHFA was created, HUD was the GSE regulator, setting the housing goals, examining the GSE's fair lending performance, their non-mortgage investments, ensuring that the GSEs were supporting their public purpose. And an agency within HUD, the Office of Federal Housing Enterprise Oversight, was the safety and soundness regulator. So then, of course, in response to the crisis, the FHFA was created, and it was intended to kind of consolidate and strengthen all those functions. But I do think that, as you mentioned, that MOU in August, the fact that both leaders are on the appraisal task force, which seems appropriate, signifies a new era of coordination. And I think that influence and coordination is already hard to miss. It's almost hard to keep up with all the fair lending related announcements. And as we've been talking about sustainable homeownership and sort of focusing on those potential homeowners who may be credit worthy but have been sort of left out of the homeownership, I think the focus of HUD and its influence on the other agencies is not just on anti-discrimination, but rather on affirmatively, finding out what you can do as an agency to promote equity. As Sasha mentioned, there are lots of things coming out of the FHFA. There's a policy statement on fair lending saying that they're going to conduct fair lending monitoring, fair lending supervisory exams. They're going to require quarterly reporting on the GSE's fair lending testing. As Sasha mentioned, their 3-year plan. And, I agree that it needs to be longer term, but these are fairly plans by the end of the year to identify barriers to sustainable housing opportunities, to set specific goals to address those barriers, point out meaningful actions that Fannie and Freddie can take, and report on their progress. So I believe it is at least full court press on affirmatively promoting sustainable homeownership in underserved areas. So I think HUD, which is the Fair Housing Agency, is going to be pushing for affirmative steps in that regard.
Well, Chris, one of the things that we think that HUD can do is right in their building, which is FHA, which has been really the engine of minority home ownership and ownership for underserved borrowers. And particular, we're going to see probably a strong FHA fund report in the next week or two, and we hope that will be the precipitating thing towards FHA ending the life of loan premiums, which they put in place in 2013, which, talk about equitable housing, that really does target the underserved borrowers. These are the people that have a more difficult time refinancing out of FHA into a Fannie Freddie loan when they pay down their mortgage. And, we'd be happy to share our numbers with people. We just did a typical loan and showed that, after 10 years, when you get to 78%, you've already paid like FHA premiums equal to 10% of the home price. That seems like enough to us. And the life of loan is going to add another $16,000 over the rest of the loan. That's equity wealth building, which is denied. The FHA fund is strong, so we really hope that they can move on that quickly.
We just published something, an op-ed piece by Ted Tozier on that topic, actually. So that was interesting. I love that in the chat, our audience is talking to each other about different things. That's always great. Talk amongst yourselves, and we'll get to what we can as well. This is supposed to be a forum for really talking about things. Let's get to one of the last issues, which is the interagency task force on appraisal bias, which we've mentioned several times, where they made HUD the lead. Appraisals are complicated, as we said, but lenders have a responsibility to make sure the AMCs and appraisers they're using are being fair. We saw that, complaint come through from I think it was a private citizen who made that complaint, and then a lawsuit. How are lenders shoring up this issue? I want to hear from everybody. Like what does that look like? Like, how do you know that appraiser who might be at arm's length from you, or how do you know that the AMCs are like, how how do lenders who are going to be held accountable for this ensure that this is something that is being done, and how should they be doing that?
I think right now lenders are kind of limited in what they can do in terms of if they were to see appraisal bias and an appraisal come in low. I think the two respective AUSs provide low value indicators or flags. So obviously the underwriter raising that to whoever their manager is, and then going up the food chain to the AMC and have them respond to it. Or I don't know, what the regulatory or what the process is, if you do catch or suspect that you have, one bad apple in an area based on a number of appraisals that continue to get these low value indicators. But I think, I think right now the industry and certainly our lenders they're looking at the task force findings and then any subsequent recommendations that come out of it. But yeah, I mean, unfortunately right now it's, I think there's not too much that a lender and specifically an underwriter could do if they suspect some kind of an appraisal bias.
Yeah, I agree completely. I think lenders are in a really tough spot on this one because all the safeguards put in place that are rightfully so intended to keep the appraiser as third party and neutral as possible and not feel any pressure. And you're talking about a situation where the value is coming in low, and now there's all these safeguards keeping the lender or the originator from pressuring the appraiser from raising it, fighting against this, right? So our best solution that we see that's in front of our face right now is the scanning technology I referenced earlier. It doesn't solve everything, but it does put a blind aspect to it where the appraiser is not going in the house, not seeing the sellers, possibly not driving through the neighborhood. They can still see the house on the maps, so it's not perfect. But we would expect that it would create a pretty drastic improvement from where we are currently. And like I said, it's awaiting FHFA approval. And to go back on what Scott said earlier, that it's great if Fannie and Freddie adopt it, but FHA is just as important, if not more so important. Otherwise, if this technology I'm talking about gets implemented, but only on Fannie and Freddie, you could see a reverse impact where people with lots of equity are the ones that are really benefiting, which is not the intention of where I think the technology could do the most good. So we'd really like to see FHA get on board with it as well.
Well,
I would echo that there's not necessarily a whole lot that can be done. Some credit unions have done refreshers for staff, increasing awareness and recirculating policies and procedures. The goal there is more so that if a credit union member comes in with this particular complaint, staff is primed and ready to be a partner, regardless of the actual outcome. Being heard, being believed, being taken seriously is really critical to the relationship between a credit union and its member, and really also necessary to ensure that the credit union is meeting its mission as a member-owned, not-for-profit financial cooperative intended to improve the financial life of that member. I would say the other thing I hear most commonly is that credit unions are looking harder at how appraisers can be held accountable when things don't look right. Many credit unions I've talked to complain that when they have reported appraisers for potential bias, state licensing organizations that are supposed to be holding them accountable don't do a whole lot. So credit unions are looking harder at what other calls can they make, what other layers of supervision are available. The FFIEC appraisal subcommittee hotline, or talking to their state legislators and regulators about these issues, because ultimately if people with power to hold those individual appraisers accountable aren't really doing that, the problems will continue to metastasize. And as I think Benjamin mentioned earlier in the call, a biased appraisal may become a biased comp. And so there's definitely this long-term compounding effect on racial home ownership and the wealth gap. So holding people accountable is definitely one of the most important pieces for meaningfully addressing these issues. And credit unions are looking harder at that and how they can be a solution in that particular piece.
Right. And especially when you're talking about more and more appraisal waivers coming out, which is great, there's no bias, there's appraisal waiver, but not if it's based on faulty data to begin with, right? Then you just keep perpetuating the problem. And it's the algorithms are only as good as the data they have to work off of. So we need to be super careful about that.
100%.
Let me just make a quick point about this issue and the underwriting standards. To make the point about, I hope people in Washington, members of Congress and so on here, which is that, independent mortgage banks, typically they do a lot of business with FHA, GSEs, the federal ones, and we don't set the appraisal standards, we take the appraisals, and we don't set the underwriting, we take them. And so that's an important policy thing is, just to bring up something that I know that I don't want to relitigate CRA, but this week New York passed CRA. And so we spent a lot of time as an organization figuring out how we can, our members who we think statistics show do a great job serving underserved and minority borrowers can do even more. And we don't think CRA is the answer. We think we need to keep looking for other positive ways. And we're coming up with some. I mean, one of the things, the barrier, we do business through our loan originators, not through branch offices. And that means that we need more minority and low income mortgage loan originators. There's barriers to entry with the SAFE Act. The states maybe can help by subsidizing or waiving SAFE Act costs. The states should be more flexible on their rules that say how many miles away a loan originator can be, so we can branch out and do more business, have our LOs do more business in underserved communities. So as this whole debate rages about CRA, we hope that we focus on the positive ways we can do more as opposed to these sort of prescriptive rules that we think are designed for banks and not for IMBs. So.
Well, that's a whole other thing. I wish we had a whole other hour on CRA, right? Especially if it's going to be applied to people who don't have branches, which obviously it is now in 2 different places. Really love this comment from one of our listeners that said appraisal bias comments are spot on. To overcome will require adjustments at the regulatory level. You can't really place the solution on lenders who risk repurchases and other sanctions for coloring outside the lines. And I think this is one of those overarching themes of like, if you have goals of expanding home ownership, you also have increased regulation. And in some ways, those things are at counter purposes, right? I mean, we want to be safe. We don't want to take advantage of people. At the same time, it is difficult to see how those things kind of sometimes go together. One thing I'd like to mention is that, we've reached out to HUD and other agencies to talk about appraisal bias complaints, and it's not a very transparent process from them to the public about how many they've got, how many they've responded to, where we are in that process. We haven't been able to get answers on that. And I think that openness at that level would help all of us if we're trying to combat appraisal bias. If we don't know what those numbers are or what that looks like, that's a hindrance, I think. So that's my plug. HUD, give us those numbers, be transparent there. Love to close this out with any other closing comments. We've got about 3 minutes left. Does someone else on our panel want to address something that's been said or one of the questions? I'll pick on you. Okay, so we do have one that said, what kind of SAFE Act reforms are needed, especially with more MLOs working from home post-COVID? So that's a totally different question there, if someone wants to take that on.
Yeah, we've been pushing hard. The states create these temporary exemptions from the proximity rules. You have to be within 100 miles of thing. We think the evidence shows that that's worked, and they ought to make them permanent. The other SAFE Act thing that I didn't mention is, under the SAFE Act, you can be denied getting a license because of a bad credit report. We don't understand what that has to do with suitability for serving as a loan originator. And so those are some of the things that I think we can do.
I appreciate that. We also had a comment on the QM rule and and non-QM lending. Anybody want to, Chris, do you want to take on the QM rule very quickly?
Well, yeah, I think, and this kind of harkens back to something I said that, there are always 2 sides to every story. So, a lot of the market is focused on how to make a QM. There are a lot of investors and lenders and brokers who are excited about the rest of the market. And so I think once we can kind of settle into where those lines are drawn, we can get to a place where, and I think this is what the CFPB had hoped all along, is that there's a vibrant non-QM market as well as a vibrant QM market. And, sustainability is always the case here, but I think that there are a lot of folks who are looking for that, what can happen outside of the Fannie, Freddie, and FHA marketplace. So I see Brendan shaking his head, nodding his head. So he may want to add to the QM conversation.
No, absolutely. And my biggest takeaway from this conversation is, I mean, between everyone on this panel, we have such a wide swath of the industry represented. And I'm really excited by how much everyone is basically on the same page with all of these issues and where the regulators are looking ahead with equitable housing. And something that's been brought up once or twice during this conversation is that we were left out of conversations when it came to the 50 basis points or the caps and stuff like that. And if we're on the same page with the regulators on where they're looking ahead, I think the importance of us being involved in the conversation so it's done in an intelligent manner is incredibly important. That's what I'd love to see come out of this and all the conversations around it.
I'm sure that your other panelists feel that way as well, right? Getting industry input. Just a side note, we did publish a story last week on the private label market, filled the void created by PSPA changes. We did see some real movement there. So I think that's an interesting story for another day. I just wanted to say thank you to everyone. Thank you to the 6 panelists on here who took your time. We know you're really busy. Appreciate your insights. Thank you to our audience who had a lot of great questions. And we weren't able to get to all of those, but really great conversations. So thank you guys so much for this lunch and learn. Really appreciate it.
Thank you.
Thank you. Thank you.
This will be available to registrants very quickly. You'll be able to get this on demand as well. So thank you all and have a great day.
Thanks.